Inflation is simply too high and they are panicking. Any normal person with a credit card knows there's only so much debt you can take. Sooner or later, the bill is going to come and you'll have to pay the piper. And in the most extreme case, you'll go bankrupt and then you'll discharge your debt. But what happens when a country keeps defying reality and they pile on endless amounts of debt? Well, we are about to find out. In our lead story today, Japan's day of reckoning is approaching and it's coming really, really fast. The Bank of Japan hikes bond buying as benchmark yields hits decade peak. Now we know Japan has been trying to defy gravity for a long time. They have been doing yield curve control since 2016. That's over 7 years of endless bond buying. The Bank of Japan has been keeping Japanese economy on life support by piling on more debt. But this time, they have lost control of yield curve control and they are kicking things into emergency mode. And why is this happening? Because yields on the 10-year Japanese bond have hit a staggering 0.775%, the highest since September 2013. Remember that Japan's upper limit for the 10-year yield is 1%, and the closer it approaches that rate line, Japan might be forced to do the unthinkable. Understand that Japan doesn't want higher interest rates. Their debt to GDP is well beyond 260%. And the story gets even worse. Over 53% of Japanese bonds sold were bought by the BOJ, the Bank of Japan. And this is the definition of financial insanity. Even the Federal Reserve hasn't gone that far with their bond buying. Now, Japan has a very funny rule that doesn't consider this debt monetization. Unlike Jerome Powell, who buys treasuries directly from the open market, he buys it from the commercial banks. Japan, the BOJ, buys their bonds directly from the Japanese government. They label it as temporary holding so they can kind of argue that the money supply doesn't really increase. But there are always consequences to buying your own debt forever and artificially trying to suppress yields. You can't contain the boogeyman forever. In a report by Reuters, economists are saying if the 10-year yield approaches 1%, Japan could always raise the ceiling up again. But can Japan stomach 2% interest rates without crashing their economy, without crashing the world? Well, whether they like it or not, they will have to do it because their inflation dream is fast becoming a nightmare and Japan is trapped. What Japan has is a demographic problem. The workforce is shrinking and the birth rate is collapsing. And this means spending in Japan is also dropping, and as a developed economy, that is a big problem. And that's why the BOJ is buying tons of bonds to push down interest rates to spur spending. They are trying to use MMT and economic theories to control consumer behavior, but things are starting to backfire. In a not so shocking report, consumers are saying that Japan's statistics fail to fully capture the inflation surge. Consumers are actually feeling prices are higher than the official data. In fact, it is 10 points higher. And I think we know by now that the name of the game is to understate inflation. But consumers in Japan are finally realizing that prices are higher in reality. According to calculations, the perceived inflation rate, which is what people are feeling on the ground, is much higher. We can see an incredible gap between the official inflation rate of 3.3% and what people are really getting hit with. And when you factor in all the items, including food, fuel, and other necessities, the inflation rate is actually 14.7% in June, and that is a crazy 11.4% difference. Now, if you're the Bank of Japan, you might be declaring victory, right? You wanted higher inflation, and now you have higher inflation. You have reached the promised land. But there's a big problem. Inflation doesn't automatically equal more spending. It actually destroys household budgets if it gets out of control. It is not rocket science, and now the BOJ has to face reality. Japan's consumer spending has dropped 2.5% in August as inflation takes hold. It has been declining for 6 consecutive months. People are just not spending anymore because everything is getting more expensive. Inflation is only good if wages are also going up. However, is that really the case? Well, that's not what the data is showing us. In a story from Reuters, Japan's real wages in August declined for 17 straight months. Price hikes are going up higher than salary increases. The Japanese government has been telling their corporations, please increase wages, pay your employees more so that they can go out there and spend in the real economy. But that is just not happening. The problem with simply suppressing interest rates to boost company earnings isn't going to work this time. And this is for two reasons. Now, the first is extremely obvious. We are moving towards a global recession. Europe is in one, China is slowing down, and American imports are also dropping. So the upside for companies to grow is truly limited. But there's simply no limit to how high inflation can get, especially when we are now facing two wars and supply shocks everywhere, especially in the oil markets. And this is setting up a perfect nightmare for Japan's inflation. The BOJ has a big problem. They are easing interest rates in an environment where the rest of the world is hiking up, especially the Federal Reserve, and this is causing enormous damage to the Japanese yen. This is perhaps the most important chart I have to show you, and this is the Japanese yen versus the US dollar. And what do we see? A total collapse of Japan's local currency. And this is the devaluation of catastrophic proportions. It's pure destruction, financial apocalypse, the economic Armageddon. The yen has collapsed by at least 20% to the dollar since the rate hike started in March 2022. And this makes Japan's imports insanely expensive because almost everything is priced in US dollars. And that's the power of the reserve currency and why a strong dollar is great for the United States but horrible for the rest of the world. Yes, Japan is an ally of America, but the laws of global economics still apply to Tokyo. There's no escaping a currency crisis when the Federal Reserve is hiking rates, but you are still trying to suppress yours. Now, some of you might be thinking, a weaker yen is great for Japan's exports, right? That should technically boost their revenues and help companies sell more stuff. After all, when the yen goes down, everything priced in yen becomes more cheaper. But as we said before, the world is slowing down and Japanese goods are just not flowing overseas. In August, both Japan's exports and imports fell. Exports fell by 0.8%, while imports fell by 17.8%. But look at the absolute numbers. Japan still imports more into the country than what they export out to the world. They have nearly a trillion yen trade deficit in August. And this is bad news because Japan is supposed to be a manufacturing and export giant. However, a lot of the market share has been eaten up by China to the point that Japan is now a net importer of goods. And looking at Japan's balance of trade, we can see they have been stacking up enormous trade deficits over the years. And this problem is getting more obvious ever since the Federal Reserve hiked rates last year. And this is a horrible situation for Japan. And that's why they're draining away their dollar reserves and they're selling their treasuries to defend the yen. The Bank of Japan knows this and they are intervening in the currency markets. Japan keeps yen traders guessing over whether it intervened. Officials decline to say if they step into the market to prop up the yen. However, once you see this next chart, you'll know that this is most likely the BOJ scrambling to save the yen. They are still trying to wait out the global rate hikes. And this is a chart of the dollar yen exchange rate. So the higher it goes, the more the dollar strengthens against the yen. In other words, the higher it goes, it shows the yen crashing. Just look at this big currency intervention just before the dollar yen hit 150. It is as if the BOJ realizes there's a psychological level to defend to prevent a panic and public meltdown. And this is only going to get worse because the global rate hikes aren't over. We are heading higher for longer. And this is where the story gets really, really dark for Japan. And let's recall what happened over the past few days, over the past week. Israel has declared war, and now there's speculation that Iran might be involved. And this is going to keep the price of oil up higher for longer, and that will drive local inflation even higher. Looking at the price of Brent crude, we can see this enormous spike up in prices that almost happened immediately after the Israel attack. Remember that a higher oil price is devastating for Japan. It's a triple whammy that increases the price of energy, crushes manufacturing, and devalues the yen even further. If oil goes up and the dollar goes up at the same time, energy prices in yen will fly to the moon. And if America goes after Iran, this will be an economic nightmare scenario for Japan. So let's analyze what Japan can do because either way they turn, it'll be a disaster. If the BOJ decides to hike rates, this could trigger a global meltdown of assets as well as collapse their own industries. So door number 2 looks more likely. Japan would just play the waiting game with the Federal Reserve and allow their currency to devalue. According to a former currency diplomat, Japan won't intervene to reverse the yen downtrend. In other words, they will allow their currency to plunge to hell. And listen to this, Japanese authorities are well aware that they can't reverse the market's tide when the yen's decline is driven by economic fundamentals. The Bank of Japan might be giving up on the inflation fight because whatever they are doing obviously isn't working. Sooner or later, the yen will breach past the 150 level, then all hell will break loose. Then we'll see if the Bank of Japan will embrace higher inflation or start to panic and hike interest rates. And every time Japan tries to intervene in their currency market, the market always forces the dollar higher versus the yen. They have tried to strengthen the yen at least 5 times in history, and each time it failed. They have sold their US Treasury bonds, they have cashed out their dollar reserves, but nothing seems to be working. And it won't work until Japan decides to let their interest rates rise. So the base case scenario is the yen weakening further. Because of the war and higher inflation, the Fed isn't going to ease off the hikes. Japan needs to ask themselves, how much further can they let the yen collapse? We are now back to the 1990 levels, which is a 33-year low. So Japan is stuck. Either the yen keeps collapsing all the way to 170 or even 180 to the dollar, but the BOJ might just do the unthinkable. They might just throw in the towel and hike interest rates. Now, this is unthinkable, but don't be surprised if they actually do it. Just ask yourselves what you have seen over the past 2 years. We had banks collapsing, 4 US banks have collapsed, and 2 wars are on our hands. And this might just be the black swan event that takes down the global economy. JP Morgan is afraid of this with their bond chief saying, "This is the one risk I worry about." Japan's hiking cycle could spark a decade of repatriation. If the BOJ decides to hike rates, Japanese investors could start pulling all of their money away from the global markets back into Japan. And if they do it at this volatile time, we can expect a total collapse. And here's the frightening thing, the time of reckoning is fast approaching. The Bank of Japan could be forced into hiking rates sooner than expected if the yen weakens beyond 150 to the dollar. And guess what? We are already there. The Bank of Japan might be taking action real soon. And let's quantify how much money is at risk of running back to Japan. Now, between 2013 and 2022, Japan bought a ton of bonds and equities all over the world. During those 10 years, at least 150 trillion yen has flown into global investments to chase yield. So just imagine the liquidity crisis the world will have once all this money flows back to Japan. If the BOJ hikes rates, then the yen will strengthen, and suddenly holding foreign bonds like treasuries doesn't make sense. Investors will start selling off their global bond holdings to bring money back home, and this puts greater pressure on bond yields, which is a nightmare for the world. So if you look at the state of the world today, it's undeniable that we are sitting on a powder keg just waiting to explode, and this is perhaps the black swan event that everyone is ignoring. And there are only two ways Japan and the world can defuse this bomb. It's either America comes out with a Plaza Accord 2.0 and devalues the dollar once again, or the Federal Reserve slashes interest rates now. And you and I, we both know neither is going to happen. The dollar and interest rates are America's greatest financial weapons, and they won't let go of control. So it's time to buckle up because almost every month we have a new crisis happening, and Japan hiking interest rates might be the bomb that destroys the global economy. But let me know what you think in the comments below. Will the BOJ pivot soon, or will they condemn the yen to a devaluation hell? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.